Yeah, no, we've definitely had a big move in yields, and it's happened in the past month and a half. To move 40 basis points in the back end of the curve is no small thing. How does it affect our view? We've got to think about what's happening in the world. Why'd we get here? And big picture is the economy is still really strong. We have maybe slightly below trend growth in the U.S. We've just had a gangbuster earnings season.
Yep.
10 out of 11 sectors just crushing it, looking really good. But why are yields higher? Yields are higher because we continue to have this war conflict, questions about oil and long-term inflation. We've got a Fed reaction function that the market is telling the Fed, we don't know what it is. Please tell us. And you've got a lot of supply in the markets, and that's what's happened in the back end. In terms of how we're investing in our portfolio, we really aren't changing much. We haven't had any kind of large duration overweight all year. That hasn't seemed to be a place that we felt could win. Instead, we've got some structured product and a little bit of high quality, high yield, and that's where we want to be. And there's nothing that's telling us so far that we shouldn't be.
How much credit risk do you want to be taking? Because I can sit there at the 10-year and clip a 470 coupon. That's a decent living right there.
Yeah, you don't necessarily have to do more than that if that satisfies your needs and your liabilities, for example. But when we think about the incremental spread that you can pick up in certain names that we fundamentally like, we feel confident doing that. This isn't a market, though, that you want to be all in, all chips on the table. You want to be, slightly defensive, but we do have a posture of more risk than our benchmarks.
You mentioned the Fed and the market saying, we need some guidance here. Do you think we'll get anything next week in Jackson Hole? We'll have Tom Keene out there asking the tough questions, but what do
Maybe
you
in the
think?
Q&A with Tom.
Okay.
I think we got a chance there. In what is the planned remarks, I don't think so. I think we're
Okay.
going to hear more about what these task forces are supposed to do. And the market is saying we don't need to hear about
I
this
just had a
exercise.
nightmare view. Can you imagine Yadahatsius on a task force? He'd sit there stone quiet like he does, and then he'd weigh in.
Right.
Where's Hatsius now dovetailed into your view? He's always been a realist, I'd say, on GDP. Does he see a pullback in real and nominal GDP? Dovetail that into what you're doing, Lindsay.
Sure. So there has been predicted by Jan and team, who we obviously listen to and is the best out there, thinking that the second half will be softer. So when we're getting these prints coming in and they are softer for GDP, we are not surprised. That's been part of the forecast. Additionally, Jan and team believe that the Fed will be on hold for this year.
Okay.
That sounds right. And the other thing that's important that he's pointed out is that inflation is coming in more benign. And in fact,
Okay.
we've seen that, which can mean that the Fed can hold.
I didn't read it, but I knew the answer because that's been Jan for 30 years, and that's why he's world class. If that's the case, can you bet yield down, price up in fixed income? That's the arch question right now.
Yeah, I don't think you necessarily need yield down, price up. You can earn the carry. And I think that's it. You've got really attractive yields. And to just sit here and clip those coupons,
To extend
that
duration.
works.
I mean, for the listeners and viewers, and where it's, they're going, okay, 2-year CD, 5-year CD. Which do you extend duration?
Yeah, I think you can extend duration into the belly of the curve, but we are not making a recommendation to go all the way out into the 30-year point.
I did.
But you can extend.
I'm putting Bloomberg Money Show together for Friday.
Sure.
And I did the TLTs out 20 years.
Yep.
You really, folks, just so I can explain this to retail America, when you go out past the Lindsay Rosner duration, there's some price change you can have, and sometimes it's ugly.
Right. That's exactly right. You have more volatility in the back end.
Lindsay,
So I don't think you need that.
What do you make of all this new supply of technology, investment grade debt into your market? These are issues we typically don't see, and the total dollar amounts are just huge. How's that impacting your market?
Yeah, so I think the market is handling it very orderly. Just to give some numbers, we've seen 1.6 trillion in IG issuance this year. That's up 34% from where we were last year. So yes, is there more supply? Sure. When it comes to the hyperscalers, we've seen close to 200 billion. If you think about the total AI complex, that number's more like 400 billion. These are big numbers, but the market is taking it in stride. These deals are still oversubscribed, but you are finding for this bucket of issuers that spreads are typically trading wider than like credits or like credit quality names. So I would say the market's orderly, and people are excited about the story. But obviously, buying the bonds of these issuers is very different than owning the equity.
So, I mean, I'm just assuming when people come back from Labor Day after the summer season, they're going to be calling you guys up again and saying, hey, we've got more issues to come. I mean, and what are the questions you ask? Are they different now than maybe 6 months ago?
Well, I think 6 months ago, there was really a question on what is this CapEx story? And is it just a runaway train? And there was concerns that CapEx could be something like 1.7 trillion for this group.
Yep.
I think we feel more confident that the number's near 1. And this is, again, trillion with the T.
Yep.
So
Yep.
that much less and feeling more confident about it, I think makes it more enticing to own this. But we very much think that there's going to be a lot of issuance. And in our particular portfolios, we are underweight the hyperscalers in investment grade and finding ways to play AI and this space in structured product and in high yield.
Okay, hyperscaler, like every single conversation, folks, there's 2 conversations. The Mag 7 equity stocks market, should I buy more Amazon? And the pros are all looking at the debt buildup. You have the advantage of one, A. Lynham, Amanda Lynham at Goldman Sachs. Where's Amanda right now on the next marginal kangaroo bond that these people are going to issue?
Yeah, so very lucky to work with Amanda now. As I said, actually, last time I was on this show.
Did you? I don't remember.
Yeah, you brought it up. I think we talked about we are blondes in bonds. What could be better? That's our tagline. Podcast coming soon. Stay tuned.
Yeah, exactly.
It's not. Don't worry.
It's out of
But what she
control.
said, I think what's been really helpful is contextualizing who's going to buy the paper and where is it going to go. And what she's been pointing out is there is a limit to how much the U.S. regular way investment grade market can take. And that she thinks the next shift will be that USIG gets saturated and had enough.
Yeah.
It will go to private credit, where there's $4.5 trillion of dry powder waiting.
And even it can go international.
And it has,
Like it has
actually.
Australia.
That's right. But those are smaller markets. So it sounds like private credit is probably the next set of strong hands to take down some of this paper, which means we're not worried about the supply.